If transferring your company to family members or employees is an exit path you're likely to consider, don't miss this show. Hi, I'm Norman A. Hood, financial advisor and host of the Exit Plan Show. I interview America's top advisors to help business owners enjoy more freedom, grow companies faster, and retire on their own terms. Along with Tom Baer, CPA and certified exit planner from Springfield, Illinois, who's joining us for episode 11 to help explain step 5 of the 7-step exit planning process, transferring your ownership to insiders. Hi, Tom.
How are you, Norm?
I'm good. We're ready to go. Okay, so today we're going to talk about how this path varies compared to selling to a third party, some of the new challenges that present itself under this scenario, the difference between transferring a business to a family member versus a key employee, some of the tax considerations that are significantly different, and how to resolve issues along the lines of treating business active and non-business active children fairly versus equally. So let's get started, Tom. How does this path of transferring a business to insider, how's it different than selling to a third party?
So as you said, Norm, in the intro, this is step 5 of the 7-step process. So when I describe step 4 and 5 to my business owner clients, I describe it as either or. Mm-hmm. So we have to, at least initially, decide which path we think is best, whether it's a third-party sale, which is step 4, or whether it's a transfer to insiders, which again is step 5 and obviously the topic of our conversation today. So step 5, transfer to insiders, the big difference is that generally that transfer is going to take more time, and you're probably, as the business owner, going to assume risk, execution risk of the business for a longer period of time, because generally the business is going to finance the buyout in the case of a buyout. Now, insiders, we should define probably for our audience what an insider is. An insider is potentially a management team, could be family members, could be an ESOP, could be a combination of all those things, and transferring it could be a sale or it could be a gift. Or again, it could be a combination of a sale to some management employees, could be some gifting to your kids, and it could be sort of a variation of both of those. So again, the difference is, in an insider transfer, the business owner transferring the business probably assumes more risk, and the transfer process probably takes more time.
Okay. So that's obviously part of the challenges, and with new challenges come opportunities, and also come new strategies. What are some of the ways you can deal with some of these differences that might be challenging?
So let me give you an example of a challenge. Let's just assume we've got a $5 million business and it generates good cash flow. So we model the cash flow of the business and we come up with a way over let's assume a 7-year period where the business owner can get his $5 million out of the business, right, through a management buyout. Well, let's also assume that business has a line of credit. Well, the business owner, the current business owner selling the business, may actually have to provide a personal guarantee on that line of credit even after he's actually signed a purchase or sale agreement to sell the business. So one of the big risks is he still retains a lot of risk, a lot of financial risk of the business, not only personally, but with the bank, because he's depending on the business to provide enough cash flow so that his management team can make the payments to buy him out, but he's also retaining financial risk with the bank. And if the line of credit, if the current ownership would default on a line of credit, then they would look to him and his personal guarantee. So one of the things we talk to business owners a lot about is your management team ready to purchase the business? And being ready, one of the things we want to look at is what is their financial wherewithal and how do we get them to a place in their financial maturity to where their personal guarantee can in fact secure be satisfactory to the bank, to where the exiting business owner can dispose of that risk.
Mm-hmm. Okay.
So one of the challenges is we see quite often is just that they still retain a lot of financial risk, not only the financial risk from the payments that are due to them, because with that, at least you have the collateral of the stock in the business or the assets in the business that you can go back on, but also, third party risks where it's a vendor, or maybe it's a bank, or maybe a bonding company where you've got a guarantee that they're going to require.
Okay. So we can actually sell to a family member. We can give it to a family member. We can sell it to an employee. I guess we could give it to an employee.
Well, there's some complications with gifting to an employee that I would get the advice of a tax attorney or your tax advisor, because the IRS could come in and determine that really wasn't a gift, that was really compensation. So there are some complications with that, and I'd be very careful with that strategy.
Okay. Yeah, because I know sometimes people feel like, well, these guys helped me build this company, and I don't have any family, so that's a good point, a good caution. Okay, tax considerations. How do the tax considerations of selling to or gifting to an insider, how do those stack up compared to a third party?
Yeah, so a lot of times there's a struggle, and when I say struggle, I mean it's a negotiation that the buyer of a business, whether it's a management team or a third party, is generally going to want to buy assets. Okay, and the reason they want to buy assets is because they can get a tax benefit from purchasing assets. If they purchase a piece of real estate, most of that real estate they'll actually be able to depreciate and create tax deductions for. So there's what we call in the financial world net after tax costs. So if you can get a deduction for something you purchase, your true cost is something less than the full value of $1, because you did in fact get a tax deduction for some of that purchase price. So there's a natural struggle between buyer and seller, where seller would really prefer to sell stock or equity, or in the case of an LLC or partnership interest, although that's a whole other side of the law. So we're going to stick with a corporate entity, but if you sell stock in a corporate entity, the seller probably gets capital gains treatment on any gain from the sale of that stock, so much lower tax rate. So there really aren't necessarily a lot of differences in terms of tax considerations from a third-party sale as there are from a management buyout. One of the things you see quite often in a management buyout is a multi-year payment strategy, and the seller can actually elect to treat that as an installment sale, so they only pay taxes on their proceeds when they collect the money, or they can elect out of that. So there's some tax planning that goes into this, and the other big issue you get into when you sell assets, because we do see a lot of asset sales, is allocation of purchase price. How should we allocate the purchase price so that it's beneficial to both buyer and seller, and how can we structure a buyout agreement to where it's tax efficient to both parties? And there are ways to do that if the facts and circumstances are appropriate and can be supported.
Okay. Now this is the one that comes up a lot. I know you're active in the ag arena, and I have a lot of clients in agriculture, and it's not uncommon at all to have one family member active in the business and another family member that may not even live in the same state that's not active. So when time comes to transfer the business, the issue of fairness versus equality always comes up, and how do you handle that?
Well, it's a sticky issue, and a lot of businesses were built by a owner or ownership team, or maybe it's a family ownership team, and they've put a lot of what we call sweat equity into that business. So I often, when I talk about exit planning, I often refer to the businesses as the favorite child, because the business owner really, in a lot of cases, spent more time with his business than he did with his kids. So it's a difficult issue. There's a lot of emotion involved, and a lot of times you get family issues that sort of creep into the business that really don't have anything to do with the business. And sometimes we will get a family business advisor involved to help work through those issues so that we can have a successful exit. But your point of what, fair versus equal is a very, very difficult issue to deal with, and it has a different meaning for each family business. One of the things I advise business owners of is, if you have active and non-active children, I would highly encourage you to transfer ownership only to the kids that are active in the business, because it creates complications down the road. The other issue I try to really impress upon business owners is, as a patriarch of the business, you really have to make these difficult decisions for your family, because we talked in previous sessions about these horror stories, and that's really what you want to avoid. You're going to have to make the tough decisions, and you, as a business owner, have to define what is fair. In a lot of cases, what's fair is the kids that are in the business, that are actually generating positive performance for the business, they should be the ones that get the business. And then you use other tools. You have assets outside the business, and you might have to purchase insurance in some cases to get to that fair and equal place that you need to get to for your entire family. So, it's a difficult issue, and again, a lot of emotion involved, but it's not one you want to ignore. And in that process, the other thing I would caution business owners about is, if you have a management team that has done very well for you, and you have told them that they're going to get a chance to own and run the business, and maybe at a majority position, you need to be careful about your need to then down the road get your kids involved, because that can really muddy the waters. Those decisions have to be made early on. And if you intend to have your kids involved in the business, and you intend to gift stock to your kids, or you intend for your son or daughter who's in college to come into the business, I think you just have to be transparent about those things with your management team and have an open discussion about it. And with your management team, who really are an extension of your family, you have to determine what is fair, right? Because the last thing you want to do is bring family into the business to the point where a key management employee feels, underappreciated, and they leave, and with that, a lot of value leaves.
Okay. Yeah, I could see where you make promises 10 years ago and then you forget about it, but the key employee doesn't forget. And
right, and that happens, and those are difficult things to deal with, and the business owner, one of the common themes I see is a business owner really wants to see the family legacy live on in the business. And, again, when you're identifying your objectives, your exit objectives, experienced advisors hopefully will uncover that and have a very open discussion about it so that we can determine how best to deal with it.
Okay, sounds good. We went right through those, so sum that up for us. Transfers to insiders. What's the essence?
Transfers to insiders, again, as we said at the opening, you're probably going to assume more risk, and it's going to take more time to transfer to insiders, and the business effectively is going to be the financier of your buyout in the case of a transfer that isn't a gift. So.
Okay.
That's the essence of a transfer to insiders.
So you're going to be sticking around a while longer?
You could be sticking around a while longer, and you're gonna want to monitor the execution of the business because of the financial risks you're probably going to continue to have.
Okay, sounds good. All right, well, if you like today's show, please visit our website, exitplanshow.tv, and leave comments or ask questions about today or anything else on your mind. I'd also like to thank you again, Tom, for joining us.
You're welcome, Norm.
And we're going to hope to see all of you back again for episode 12. And of course, Tom will be back, and he's going to talk about step 6 of the exit planning process, which is business continuity. In the meantime, please visit our website and leave your comments and questions below today's show notes. See you next time.